settings to this, just to make sure. Hello everyone. I think you guys can hear me. Just to be sure, I'm just trying to make sure everything is all right. We are trying to make sure everything is all right before we dive straight into today's video. Today's video has a very quick, not really very quick, but very short thing to do. Well, let's just give it a second. Okay, so we're good. So yesterday we learned about, is that it? Is it working? Is it working? All right. So right, chat is working. I hope to see you guys here today, and I'm happy to see you guys here today. So let's dive into it, right? So yesterday we learned that fundamental tells you the intrinsic value of an asset, while technical tells you the time, right? The time to actually come in or go out of an asset. Well, nobody tells you how to actually use both of them at the same time, right? Without contradicting yourself. And that is what today is all about. Today is all about the power of confluence, combining fundamental and technical analysis. Now, if you were not here yesterday where we discussed about what fundamental is all about, the video is up on the channel. To check the live streams you see yesterday, and you see it right there. All right. Now, the power of confluence is what we have to do today. This has to do with, I'm expecting, right? This is the first time I'm going to read this, but I'm expecting how you kind of combine both of them to get a better view of the market, a better way to actually understand and trade the market. In that case, let's see. So it says, the power of confluence combining fundamental and technical analysis. That's cool. The true holy grail of trading isn't one style or the other, it's confluence. By integrating two distinct methodologies, you create a robust framework for high probability trade. I mean, that's so true. That is so true. I mean, just think about it. Has there ever been a time you had two different strategies, right? You had two different trading strategies and they both fell into a particular price level. You would notice that that price level tends to most times function than when you just specifically pick only one. It happens a lot. So by integrating two distinct methodologies, you create a robust framework for high probability setup, and that's so true. If so many things are confluencing that a particular zone is most likely a reversal zone, then that zone is most likely a reversal zone. It's just like in the battle of a court, right? If you go to court and too many evidence are pointing that you are a criminal, even if you are not a criminal, at this point there are too many evidence pointing at you. So therefore, it makes you a criminal. That's just the way it is, right? Now let's see. It says the features, the fundamental analysis and technical analysis. Now, primary goal of fundamental analysis is to determine the intrinsic value, while technical analysis is to anticipate future price movements. Okay. And that's so true. You cannot actually anticipate price movement by looking at the fundamental information. You can anticipate price direction, but not the movement. I agree with that fact. So the focus for fundamental analysis is economic data and news. The focus for technical analysis is volume and price action. That's clearly what you see on the chart is all about price, and it's like price and time. That's what chart is all about. The chart is basically price against time. I don't think anybody needs to perform any miracle for you to understand that. That is what you see when you look at the price charts. Sorry, hold on. I'm trying to get a price chart up here. Oh, I already have it open. So yeah, right here. So the price chart is all about, I'm going to put every single thing. Let's just hide every single thing, right? We'll hide all. Okay. So a price chart. Your price chart is simply just like we said before, price against time. So what is here, as you can see, this is price, and then this is time. So that's what price chart is all about. That's what you actually trade every day on the chart. Okay, so it says time horizon, long term, all the way to weeks to months, while technical chart analysis can give you short-term views such as minutes and days. I don't think I completely agree with that, because I mean, there's something called the monthly chart, right? There's something called the monthly chart, and on the monthly chart, you can actually predict the forthcoming weeks and some days just by looking at the price chart. I mean, take a look at it. We saw a month where price fell down, and we feel like the price will go down a little bit more. So, and if you go down to the recent days, you see price has actually gone down a little bit more. So yeah, but truly it does have is far more short term compared to when you have fundamental analysis. So this is best for direction. Like see, I already said it, right? Fundamental analysis is best for directional bias. So it just tells you, okay, this market is good to go up or go down, right? While technical analysis tells you timing entry and exit. So if you have a directional tool telling you this is going to go up, what you are waiting for is the right time, and the right time to enter, right? And the right time to exit the market. So that's what technical tool is all about. So the power of confluence, how to build a hybrid strategy. Now, we are learning fundamental analysis again, right? We want to understand fully well what fundamental analysis is. You cannot do that without learning the basics, right? So the basics is this, right? It says the most robust trading strategies do not rely on a single point data or single data point. Instead, they use confluence, the points where different types of analysis agree. By combining fundamental bias with technical timing, you can filter out low probability setups and trade with more conviction. And this is so true, right? So let me explain what this whole part is trying to say, because this is what I understand, right? I may be a bit wrong, but this is what I understand. When you look at the fundamental of an asset, for example, let's pick up this tool. For example, this is supposed to be my device holder. It's a phone stand, right? So device stand. I could open it like this and put the device. So let's say this is a very important tool to the world, right? A very critically important tool to the world. It's made of plastic. There are different types of plastic, but it's made of plastic. Now let's assume um, if there's a price chart for this item, the price chart is definitely going to look something like this, right? It's going to look something like this if there is a price chart for it. Similar with the same price chart as you see for every single thing you've ever traded before in your life. There will always be a price chart for it, and that's just the way it is, right? Now, if this price chart does this kind of thing, let's assume this is the price chart for this item. What this means is, at way back in May 13th, this item was gonna cost you about 0.72 Australian dollars, right? It's gonna cost you, let's just call it dollars to this. It's gonna cost you $0.72. That's about 72 cents, right? And then today, it's gonna cost you 69 cents. What do you think is the reason why this item dropped price? Like, why do you think the price came down? You could say supply and demand. Yep, that's true. That is like the easiest thing to remember when it comes to this price situation. A lot. It's very easy. Fastest thing you can ever think of. But there's something else I want you to think about. Do you feel, don't you think the availability of plastic is now either higher, or probably they found a cheaper way to make plastic, a cheaper way to mine plastic, a cheaper way to create plastic, or this item, they found a better way to make the machines that actually produce the parts. So that's the thing, right? That's the whole thing. Ooh, something happened. Sorry about that. So that's the whole thing, right? In the situation where, apologies, this guy nearly made me fall down. not long ago. Okay, so this price severely dropped, right? The price severely dropped for this item solely because there are so many reasons it can happen. There's the situation where the plastic item became cheaper, right? The plastic the plastic for creating the stuff became cheaper. That's one aspect of the situation that could have happened. There's also the situation whereby um, the let's say the company found a cheaper way to produce the item, right? There could also be a situation where the company found, should I call it, cheaper labor, right? Cheaper labor in building the item, way cheaper labor. And all those things, they all put together to make the situation change, right? And the situation could change and then finally become easy to make this item for a cheaper price. That is what this is basically all about. Now, do you think if you understood that this is the situation of the company, right? Let's say you understood that the situation of the company is that their finance is so good, then they've discovered a cheaper way to make this item. They've discovered better machines and cheaper ways to make this item. Do you think it would not be cheaper for this item in the market? Like, do you feel this item will not drop in price? Not value now, price. There's a difference between value and price, right? Price is the agreed amount we decide to pay. It's similar to value. Value is a show of the price. Value is a show of, is a price. How will I explain it? So value is more like the concept of belief for an item, while um wealth price is the actual written down value, like the numerical value of an item. That's the way it is. So there's a numerical value, which is the price, and then there's the perceived value, which also affects that price. So if knowing fully well that the company producing this item can now produce it for a cheaper amount, the perceived value of this item is going to actually come down because, hey, this thing is everywhere, it's becoming cheap, it's going to become cheaper. So that's just the back logic I want you to always think of when you think of this kind of things, the fundamentals behind things. For you to produce an item, you need to, there are a lot of things involved. If those things involved in producing an item is getting cheaper, then the item is supposed to get cheaper. If those things are becoming more valuable, that means they're becoming more expensive, that item is going to become more expensive. So with all of that, if you understand the fundamental bias of an item, you already know the direction price is going to go. Now, because you know that this company has a cheaper machine or cheaper labor, you don't say you will go out tomorrow and buy this for cheaper price just like that. No, it will take time before it starts to reflect in the price. And that is what technical analysis does. Technical analysis is what you now know at what time would this start reflecting on the chart, would this start reflecting in price. That is the way it is. So how a hybrid system works in practice. A professional workflow usually follows a top-down approach. The macro directions, the why. First, you look at the economic landscape. If a central bank is raising interest rates and employment data is beating expectations, you have a fundamental reasons to look for long opportunities on that currency. So understand, right? This is one thing a lot of people miss in Forex. I like this part here. It also says market sentiment. The who. There's the why, the who, and the when. The who is next, gauge how other traders are positioned. If retail sentiment is heavily one-sided, it can often signal a potential reversal or a squeeze. That's that a savvy trader can capitalize on, right? So if the retail data comes out, oh, everybody in the retail space are, should I say, shorting a particular asset, there's a high tendency that that asset is about to gain value. Why? Because they have a lot of people they want to dump it on. That's what it means. So there are people that are going to buy it right? That people are going to buy it. Now, sorry, if a lot of retail people are selling an asset, that people are the main traders are the ones buying it because they know these people don't know that what they are offering of for cheap is going to gain value soon. Now, technical execution, the when finally go to the chart, use support and resistance level, candlestick patterns, or indicator like the RSI to time your entry in the direction of fundamental analysis. Streamlining the process with tools. When you can manually track economic data, retail sentiment feeds, and CFTC reports, many traders use softwares to centralize this data. At A1 Trading, they developed something called Edge Finder, which replaces basic fundamental analysis and is designed to speed up the entire process. So this is the Edge Finder. This is more like ads right now for the Edge Finder, but it's a tool used by a lot of their traders to carry out the entirety of the why and the who. That's what it does. It calculates everything about the why and everything about the who's, and then gives them a direction to take. It also takes a little bit of the when also, which is the technical data as you see here. It says technical sentiments and all the rest are all macroeconomics, right? So it calculates that who, why, and when. But let me break this down for you. There's the who, there's the why, there's the when. But this is where a lot of people miss it. In the Forex space, right? In the Forex space, the little thing you miss is that you're not just um, you're not just calculating for one asset. Again, this is where, like I said, this is where people miss it. People think you calculate for one asset and you're fine. You've gotten everything it needs, right? For example, you pick up the news for the euro, and because you know that the euro is strong, you will go into the markets, in the Forex markets, right? And you want to go and buy the euro against any other currency. I'm very sure you will most likely end up with profit in probably one or two and loss in the rest. So I'm going to show you something right now. I personally have a dashboard, right? I have a personal dashboard where I did all of this. They have their own dashboard. This is not their dashboard. This is my personal dashboard. And what I do is I pick up the why. The why is something that is actually open to everybody. It's economic calendar. So sometime in the future, we'll be looking at economic calendar and how it works and what it's talking about, right? But for now, the why is economic calendar. Now, the economic calendar tells you why something should either be valuable or not valuable. The economic calendar tells you everything regarding currencies. So economies actually, and economy is basically the show of a currency strength or not, right? So let's look at it like this. If the economic calendar can already show you the why, and then you have COT reports, which is the CFTC's report. Let's head straight down there. This is the CFTC's report, the COT report, which tells you the whom. These are the participants of the market, the main participants of the market. These are the who. It tells you the who in a market. You have, if you look at it, there are three items here. Let's go back to it. There are three items here, the why, the who, and the when. You already have the why, you already have the who. So basically you have 77% of all the information you would ever need to trade in markets. And then what you do right here on price charts is just discover the when. That's all you come back to do on the entirety of technical aspects. You come back to discover the when. That's all. Now let me put this in a very explanatory manner, like in the simplest manner I can explain it to you guys. Let me get a whiteboard. So let's use a blank sheet, like a blank canvas. The fundamental analysis. This is fundamental analysis right here. You understand fundamental analysis, FA. Basically, it's what? It's the why, the whom. When you hear fundamental analysis, it's an analysis that has to contain the why and the who. Fundamental analysis has two parts. But the thing is, fundamental analysis is actually, first and foremost, the why. This is what fundamental analysis is all about. It's not about any other thing. It's not trying to make anything big. It's why. Then, I don't know why this stuff is rocking like this. I'm going to take it out of this place. Let's take it out of this place. Right. So, fundamental analysis is why. What is whom? What do you think is who? And we already know what when is. Everybody already knows what when actually is. When is your price charts. I don't know why stuff is doing like this, but I would like to duplicate this. Yeah, that's better for me. All right, so we have fundamental analysis telling us why. We have price charts telling us who. The only thing left over here is one last situation, which is, simply put, the COT reports is the who. That's what this whole thing is trying to tell you. The why is the fundamental analysis. The why is the intrinsic value. Sorry, looks like it was hanging in my throat. So the why is the intrinsic value. The COT report is the who is trading, and your price chart tells you when you should enter a market. So I understand if I understand that the central bank is hawkish. I understand that employment data is good. So this currency, in terms of this place, should be good, right? It's a good place to buy. However, I looked into the COT reports and then I saw that the big traders are buying. So they also saw that this economy was good and they are buying. The only thing you should be doing in a price chart at this point is to be looking for buying opportunities. I don't think this is correct. Opportunities. So this is the way it works. I know the data. I know these guys are buying. So therefore, I can start looking for buying opportunities on the chart. That is simply the way it works. Buying, buying, buying. When I see these ones, let's say the bank is now dovish and employment data is bad, but these guys are still buying. At this point in the market, I will just sit on my hand. When these guys start selling, the who's, mind you, start selling, then I'll start looking for selling opportunities. Do you understand? And then when we see things like let's say this is hawkish and yet employment data is bad, don't worry, very soon you understand what all of these stories mean. You understand it very well. And the COT guys are selling. This is a position where you won't just buy or sell. You need to look at how hawkish are they and how bad is the employment data for real. That way you will know whether you should buy or sell. So in other words, you are waiting for the data to align. When the data align, then you have a choice of either buying or selling. Now, this is what I personally have right here. Now, I can monitor every single currency. You can see this is the New Zealand dollar, right? I can go and check up on all currencies, all the fundamental information regarding all currency. So when I go to all currencies on my dashboard, I can track out and say, oh, okay, what is really happening for all the currencies for real, right now. I need to look at all this information. Sorry if we're having like some network lags, but it's going to pass over in a minute. All right, so we're back. Now, we have a situation where you can see the economic activities, the economic data of the different markets, right? These different markets right here. I have the situation of each market. Now, you're looking at this data and I want you to ask yourself, do you think an economy that has such good data, right, is weak compared to an economy that has this kind of data? This is the euro against, I think that was the euro. Is that the euro? So this is the Canadian dollar. So do you think this Canadian dollar economy is better than the Japanese economy? Mind you, this is something you need to take note of. The better an economy is, the more money is going to flow there. So for example, let's assume you yourself, you have millions of dollars and you want to invest in a business. You want to actually run a business. Do you think you're going to go to the British pound economy right now with all this red data? Let's assume the economy is this bad whenever you're looking at this video, right? You're looking at the data with this kind of economy. The employment data is way below zero. It's way below 50%. 50% is a good, say, flat range. 100% means it's good. Lower than 50 means it's bad, right? So you're dealing with an economy that has this situation right now. And then the economic activity is this bad. The inflation data is this bad. Central bank is flat. Would you think you would take your money to the British pound, or would you take your money to the Canadian dollar where you see that everything is good? It's simple. You would want to build a company, invest in people's company that is in the Canadian economy compared to the British economy. And what does that mean? Well, let me tell you how. This is a way that people never think of when it comes to forex. The reason why you should be following a currency or an economy, the currency of an economy that is in great shape, is simply because that economy has more money flowing in it. That's simply the reason. And when you say more money flowing in it, let me explain. If as a Nigerian, I want to invest in the Canadian economy, let's assume, oh, Canada is somewhere where business is really booming, right? I want to build a factory in Canada, or I want to invest in buying produce from Canada. Do you know what I have to do? Do you know what I have to do? I have to convert my money to dollars and then convert that dollar to Canadian dollar. So guess what just happened? I sold my cash at a cheaper price than it's supposed to be worth to get either the US dollar either to get the US dollar and then sell that US dollar for cheaper than it is again to get the Canadian dollar, or I will sell my cash cheaper than its original value just to get my hands on the Canadian dollar to pay for that item coming from Canada. That's how it works. So think about it in that light. If an economy is really good, just know that a lot of business people are converting their money to that economy's currency so that they can invest in that economy because they want to reap the good situation of that economy. They want to reap profit from that kind of economy. That's the way it works. When you have an economy where the whole thing is the other way around, in this case, we're looking at the British pound, the whole scenario turns the other way around. So if they had investment in that country, they would sell those investments, those assets, that money for another currency. so that they can recuperate as much as possible before the economy tanks and then their currency is much less valuable. So that's the way it works. That is the why. This is how the why works. In case you've never heard it before like this, and that's what we're doing on this channel. I mean, that's why you should click subscribe in the first place, right? We do this analysis. We're doing the fundamental analysis classes. We're going through. I'm reading too. I'm trying to learn it, but at the same time, I'm also teaching you guys from the perspective I see it and how I've learned it to a good extent to the point where I am. Now, the who. We just explained the why. We just finished explaining this the why. This is the why, right? Now we want to focus on the who. Now the who, when we talk about who is participating in this market, it's simply the big players. In case you've never been told before, right? In case nobody has ever said this to you, I'm going to tell you this truth, and it's going to be quite painful, but this is a truth. You as a retail trader, right? Me, you, all of us that are trading $100,000, $200,000, $1,000, $100 account, none, and I'm sorry to say, but none of our cash is getting to the forex market. The forex market is trillions of dollars, but none of your $100 is getting to the market. You're simply trading against your broker. That is why you should be looking for an a-book broker. An a-book broker is a broker that actually takes your trade to the market. But have you ever wondered why a-book broker is not cheap? I'm going to tell you why. It's simple. The cost of getting this data feed, you see this data you see right here that comes up here. The cost of acquiring this data feed is a lot. One. Secondly, such person should have a huge capital. And when I say huge, I'm not talking about your measly 1,000 or 100K dollars or even $1 million. You should have capital, and huge in the sense of you're talking in the levels of tens of millions and hundreds of millions of dollars to even start up the firm that's going to be credible enough for them to sell you this data. That is, you see this thing you see here, it is literally a table. To be very honest, it is a table that is plotted on a chart. This, let me show you what it is. I'm going to show you directly from here. So for me, I'm able to source this data for free, not because I'm some smart guy or some big guy. The data, you can source it for free. But for you to participate in the market, that is when you need the billions. This is what you are reading on the chart as a daily chart. If I put this on a candlestick chart, it is going to appear the exact way you are seeing it. Now, you need to plug directly to a data feed. And look, I can look at 1 minute. What does it mean? It means that probably every second, this data is being updated every second on the back end of the broker or the source feed provider. In this case, when you click on trading view, you come here. Let's say on trading view, right? When you come here, you see these names you see beside these names you see here. These guys are connected to source feeds. Those feeds are simply aggregating the current value based on the total amount of orders that has been filled in the market. That is what this price chart is all about. They have filled the order. That's what it is. Now, why did I go back to the price chart? It's simple. This is simply because when you look at this price charts, you're not looking at um, just candlesticks. That is why you can make it into a line chart. That is why you can make it into any kind of chart here. You can make it into any kind of, it's a table. It's just a table of data feed sent to brokers to project in whatever manner it needs to be projected in. You looking at it as a green and red candle, blue and black, orange and red, whatever color you want to give it, or even whatever style you want to look at it as, doesn't matter. It doesn't change the market. It doesn't change anything. It doesn't make the market less, should I call it less effective or more effective. What happens is simply that that data is projected to you in a different form apart from the table. What I have is the same thing as this. This is a daily price record. And what I have here is also a daily price record. So what do I mean? I have a daily price record of Australian dollar against the Canadian dollar all the way from, this is 15th of March this year. And then these guys, they have daily record of, let's go to Australian dollar against the Canadian dollar specifically. AUD card, where is it? So they have this same data, but for years. So imagine they have an, not in this case, it cannot be an Excel sheet, right? It's a spreadsheet, yes, but it is a huge data point. So they plug into a data point to get this data. Now, why did I go into explaining all of this for you guys? It's simple. When you try to look into the who, sorry, this is the who, the who, the participant. The market moves in large volume. It takes millions. It takes a million, a million. Is it a million? Yeah, it takes $1 million for price to move from, let's go to the euro against the US dollar. That's the most traded asset in the world. It takes $1 million. What I want to explain is right here. It's right on this side of the screen when I put it up. Perfect. So it takes $1 million for, you see this last digit you see here, this very last digit you see here changing. It takes $1 million of other fields for this digits to change by one. This last digit you see here, this very last one. For every move it goes, let's say 8 to 9, just know that the main traders have spent $1 million buying that asset. Let's say from 0 to 1. And for it to go from 1 to 0, main traders, the big traders, have spent $1 million to sell that asset. And when I say sell that asset, you are not buying assets as a trader. We are not buying assets. We are speculating the assets. The people who are actually buying the assets are companies who are carrying out transactions globally. Now, with their global transactions being carried out, what is happening here? A lot of cash. The quote currency here is the US economy, is the US dollar. The base currency here is the what is it called? The base currency here is the euro. So what this simply means is, give me a second, I just want to check up on something. So what this simply means is that the US economy, right, currently, when you see it going down, it means the US economy is stronger. But how did that intricate value come? It's because you see those big traders in the market, they are actually carrying out more transactions that convert their euro related assets and currencies and value. They are transferring a lot more of that value into US based related assets. That's what it simply means. So if, for example, let's say Apple closes, let's assume Apple has a European shop and a UK shop, right? A US shop and a European shop. I just want to show you an illustration. So let's assume Apple has, let's do it like this. They have a shop in Europe and they have another shop in the US. So I'm going to make this a little bit yellow. I'm looking for a color closer to the US color right now. All right, so this is the situation. Now, what do you think happens if, let's assume, the biggest companies start to move their assets out of the Europe into the US economy? Do you think the European economy will continue to gain strength when you look at this price chart? No, they would not, simply because the money is moving. The money is moving out of the euro, it's moving into the US. So I want you to look at the chart like this. Whenever you look at this chart, I want your brain to always think about the price chart like this. You take up, you say everything above this place is euro. I didn't want all this stuff to show up. Let me just let's put all of this to bed. Yeah, I mistakenly closed the one that's also important. So anything above is euro, so the base, the first currency you see, and then anything below is US dollar, so USD. So whenever you're looking at this price charts, this is how you should be looking at it. If price is going up, it's going towards the euro. If price is going down, it's going towards the dollar. And simply means the strength of this economy, right? The strength of the economy, it simply shows you also the strength of the economy, because this is how it is. It says if it's going up, it's saying that the European economy is getting stronger against, specifically, this is where you shouldn't miss it, specifically against the US economy. If it's going down, it's saying that the US economy is stronger compared to the European economy, specifically these two economies. And this is where people mix it in Forex. In the Forex space, you are not just checking out the value and the strength and the stories of the European economy. You're doing it and you are comparing it to the values and the strength and everything of the US dollar. Now, if you look at this, this dashboard here, over here, we can simply see everything we want to see. We can say, oh, this one is stronger, the other one is weaker, stuff like that. It's easy, it's cool, right? But this is what you miss. You cannot say because in this case, let's just pick the best thing here, right? The Canadian dollar, right? The Canadian dollar right now is the best thing right now, right? It's the best thing. I'm just going to go buy the Canadian dollar against any economy, right? So let's open any Canadian dollar related chart. This is the daily chart, don't forget. This is CAD against the Swiss franc. What? How? Are you surprised? Are you surprised? Okay. Why are you surprised? I mean, let's use the same logic. The CAD is up. Anything up is Canadian dollar. Anything down is the Swiss franc. So CHF is Switzerland, like Swiss franc. So the Canadian, why is it not going up? I mean, we just did economic value and we saw that CAD is much more valuable. Why is it not running up? Well, apart from the fact that CAD has value, people actually have to say, yes, this value is valuable. Do you understand? And these people the people that say that yes, something is valuable are actually those traders. So the traders, the people who are actually carrying out those buying and selling of assets, materials, goods and services, products, those are the people that are telling you this is more valuable. You've heard the more valuable part from the economic data release. That has passed. The one you need to also pay attention to is the who. There's a difference between this thing is worth $1 and people agree to pay $1. There are two different things. Something can be worth $1,000, and if people are not buying it at $1,000, what happens to the price of that thing? It will fall, even if it is worth $1,000. And that is how the who comes into this place. The who is very important. This who, what do people think? Even though we know why this thing should be worth $1,000, do people see that this thing, or do people think that this thing is worth $1,000? Are they investing in it in a way that we will say it is worth $1,000? If they're not, then that value is not going to get up to $1,000. If they think it's $750 and it is worth $1,000, you will most likely fall within the ranges of $800-900. Simple. It's that simple. There's no miracle you can perform to change it. So with that understood, the last thing is the when, right? Is the when. So you bought an asset, or you have an asset, you have an item. I'm just going to put it right here. So let's say you have an item. We'll call it H. That's the name of the item. The item is H. When you did the production, the cost of production and everything, you realized it was going to cost you, it's a US based something, right? It's going to cost you let's say um 10 bucks. It costs you 10 bucks to produce this item, right? You spent 10 bucks to produce this item. That is the why this item is 10 bucks. This item is 10 bucks because the cost of the materials I used to produce this item in total is 10 bucks. The label and everything is 10 bucks. The who? Which people are going to buy this stuff for 10 bucks? If, and this is a very funny if, and to show you how brutal reality is, if the people look at this item and perceive, let's call it P, the people look at this item and they perceive and say, this item is not worth 10 bucks. It doesn't do anything for me. They won't buy it. If they don't buy it, this item is not going to move. This thing is not going to gain value. But let's assume this same item, you decide to tell people this item is going to do this, is going to do that, and you're going to sell it at 20 bucks. Now, people have a price to gauge. Then they now say, oh, what's the value of this item to me in reality? Like, what do I use this item for? Is it useful? Does it make any sense? If I buy it, can I use it to do anything? Is it worth me spending that huge amount of money on? That is what people would think about. And when they think about it like this, the next thing that comes to their head is, I think this thing is worth paying 15 bucks for. Do you know that on the price charts, this is the funny thing. On the price chart, this is what you see. You're going to see a price chart that looks like this. Let me just draw a caricature price chart. Don't laugh at me, please. What you're going to see is this. Let's assume this is 20 up here. This is 20, and this is 10, and this is 0. What happens is this. When you brought out the item and said it was worth 20, price is going to go like this. When you saw that people were not buying it for 20, what happens? I was drawing something just now. I don't know why this stuff is misbehaving, but hold on. I don't like. All right, so where's that pencil? Jeez, I'm so lost in this item. Okay, so the price is gonna go straight line like this at first. And what happens next? Remember, this is 20, this is 10. Because people are pricing it at 18, it will start coming down like this. At 15, sorry. It will start coming down like this until it gets to, this is 15 right here. This is 15. But it will come to 15. If people start seeing that, oh, this thing is more valuable than 15, and you decide to stick the price at 20 and you're not selling any further, what happens to this thing is it will stay at 15 and slowly start coming back up. As long as people keep seeing the value, right? It will start coming back up. It will come to 20 and it will come to a point where you start to feel like it's more than 20 at this point. I feel like it's much more expensive and it goes up. People get tired of it. They don't want to buy again. They are not buying. It's too expensive. We don't feel like it makes any sense. This is what's gonna happen. We don't feel like it makes any sense. Oh, we can't sell it below this value. Right now, you're already at 10. As you can see, you are already at 10. And what happens next is this. Your company is going to close because you cannot meet up. You can either run in loss or you close your company. Same thing happens for currency. If people who are buying the dollar think that $1 and 50 cents, sorry, I don't know why the stuff is difficult to use today. I'm just going to clean this up. So let's assume they see the dollar as $1. It will cost one. If you take €1, you will get $1.50. If you take €1 to the US bank, it's just an assumption. I'm not saying this is what is happening. So assuming we take $1 to the US bank, and you say you want to change your €1 to the US bank, and you want to change your euro, let's say they will give you $1.50. If the business in euro is beginning to die and people are starting to come to invest in the dollar, there will be so many people buying the dollar that selling to you at $1.50 is now considered as cheap. It will then become $1.20. So they will start giving you less dollar by the moment because of the amount of the who that are buying the dollar. Again, this is the who. The amount of the who made the dollar cheaper. Too many people are buying it. Too many people are changing. Too many European who's are changing to US who's. So therefore, we cannot be giving you such a high amount anymore now. We have to reduce the amount you are collecting. It's too much. And then the when. The when is the easiest part actually. I think the when is by far the easiest part. The when is simply, when do I enter a chart? This is when you learn the strategy and you just say, okay, my strategy says that if I see that the candle has a wick at the bottom, I should buy. Because this one has told you, because over here you've seen that, oh, okay, we should be buying. The why has showed you a reason to buy. The who, the people who, the big traders, they are buying too. So therefore, you are looking for your strategy to just say, oh, let me see a candle at a wick at the bottom. And then what do you do next? Obviously, the normal thing. You place your buy and you aim to sell somewhere reasonable. And you can see you end up in little bits of a little bit of profit for yourself. So that's basically all for today. We've seen the who, the why, and the when. The why, the who, the when. Fundamental, sentimental, and technical analysis. Fundamental analysis for you to understand why something is important, why something is not important, why something is more important than something else, and why something is less important than something else, which is the thing about Forex. Forex is all about comparison. Forex is not just one item. Compared to stock, in stock market, you can, let's look for Apple. Let's look for Apple stock. So in things like stock like this, you're only looking at the why of Apple alone, the who, that is people who are buying Apple stock specifically, and then when to come and buy your own Apple stock. So if people who are selling Apple, people who buy Apple stocks, yeah, we're not buying Apple stock anymore, this is what is going to happen. You're going to see this. That's what you're going to be seeing. You're going to be seeing this whole situation. Once people who buy Apple stock say we're not buying again, this is what happens. When people say we want to buy Apple stock, those same who, this is what happens. So that's the way it works. Now, unlike things like stock and the rest, when it comes to Forex, currency, Euro, USD, and the rest, you are looking at two sides. We're looking at the why for the euro, the whom for the euro. We're also looking at the why for the US dollar, the whom for the US dollar, and then we're looking at the when for both of them also. That is the way it works in the Forex space. So I hope you learned something real great today. We did learn a lot of things. So going by the standard checks, let's see um, what we have for tomorrow. Tomorrow we have introduction to core indicators, and we'll be reading through economic indicators, things that actually tells us why an economy should be valuable or why a particular currency is valuable. That is what we'll be going through tomorrow, and I hope to see you guys there tomorrow. I hope to pass on this knowledge and read alongside with you, because I am also learning alongside with you, and we're just trying to make sure we become very good at it. Understanding the fundamental is key. I personally believe if you understand the fundamental, you understand a whole lot, right? You understand a whole lot of the market. Let's just look through. Tomorrow we'll be going through the economic indicator PDF. So let's see, where's the economic indicator? Yep. So we'll be going through the economic indicators cheat sheets tomorrow, and this contains things like the trading unemployment claims, such as jobless claims. We'll be going through inflation data, GDP, interest rate, deflation, and geopolitical events. That's a lot. Are we supposed to go through the whole thing in one go? That's a lot. I think that's a lot of information to put into one market. Okay, so we're putting it into one day. I think tomorrow is going to be quite long. We'll divide it into 2 days anyway. Hey, Henry, thank you for coming today. It's good. Yeah, I did work on it. I had to get myself an earphone that works real good. Shout out to Henry. He's one of my top people on this place, and I enjoyed speaking with him a lot. So, tomorrow we'll be dealing with all of this, the unemployment claims and all of this stuff. We'll learn what each and every one of them means. We'll figure out exactly how they function and how they kind of create a better economy for all traders, right? How they make you not just create a better economy, more like they kind of tell you what is most likely going to happen soon. And then you're able to put yourself in the right spots. This is everything you see on your economic calendar. Personally, I use investing.com. There's Forest Factory, and it is absolutely great. It is basically the same thing. The only reason I use this is because I can easily copy and paste into an Excel and be able to parse it and change it. That's all. But apart from that, it's the same news for everywhere. Forest Factory, investing.com, Fast Bull, you name it. Whatever you're looking at, even on TradingView, there's an economic calendar. You simply just go to the economic calendar on TradingView. It's there, it's everywhere. You can see the economic calendar everywhere. But however, you need to be able to track it. You need to be able to know that this change happened yesterday and this change is happening today. And that's why I have a dashboard of my own. But tomorrow we'll be going through each and everything. And what you see here is basically news. You've heard of unemployment claim. Today there was a huge news release for the US dollar. That was non-farm payroll, manufacturing payrolls, initial jobless claim. See unemployment rates, non-farm payrolls. And these are all data that matters to that they speak volume of the current state of that economy. So if those kind of data they are coming out good, that information is coming out. Oh, we have like major growth, we have major economic information, we have good jobs data, right? If they are coming out with things like we have good jobs data, it simply means that that currency is going to be gaining. So I just want to give you a small example. Today we saw the US dollar released lots of news, and I'm just going to show you a quick example of what happens, why it is important to learn fundamental analysis. So if you go back to what happened today we had the US economy. I'm just going to filter specifically for today's date. This data contains a lot of days. So specifically for today's data, and we're going to go straight for just specifically the US economy because it's the biggest economy. Everybody trades it, everybody goes there. Now, if you look at the US economy data, this is the data for today. We have lots and lots of bullish news. We have also lots and lots of bearish information. It's a lot. Why am I showing you directly from this page? I can show you directly from my dashboard if I choose to. I have it all here. This looks more presentable. That is why I have it here. This is far more presentable, way more easier to read. So let's use the dashboard to do it. We check out everything US economy, and we say we want to see just today's data. Now that we're looking at just today's data, I want you to pay attention to what's happened. So my system is automatically programmed to pick out the most important news I need, and we don't need to see the rest. Honestly speaking, we actually don't need to see the rest. Why? Because there's something called analysis paralysis. You look at too many information, you get confused. You can see that there were a total of how many? This is about 21 data release today. My system specifically filtered out just 2 key points and said the rest of it doesn't really matter much. I know there's one of the data you're looking at here that really matters, like this initial jobless claim. However, initial jobless claim is a leading economic indicator for employment specifically, right? But on my dashboard, what happened in the US economy today majorly came from the non-farm payrolls, and the unemployment rate data. And what happened to non-farm payroll? It came out bearish. Do you know what happened? The US economy lost value. So let's go back to this logic here. The US economy lost a little bit of value, meaning it's no longer as strong as it used to be. What do you think happens? It means that people from here would want to jump ship into an economy that they think is better. In this case, it's the euro, right? And then let's go look at the euro against the US dollar chart. Do you see that today markets moved in favor of what? The upside. What is on the upside? The euro. So it's basically that simple. But do you wait for the news to just come out? If the news comes out, how long do you wait? That is why timing is there. Now that you've seen the data comes out like this, do you think in the forthcoming days, this is a question I want you to just go and think about. Do you think in the forthcoming days, if more and more data keeps coming out and the US dollar doesn't have like too good um too good data presentation going forward, do you think that this chart is going to go up or is going to go down? It all depends on the information coming out from the European economy and the information coming out from the US economy. So if you notice, we've gone full circle. We've gone back into why. We've gone full circle. We've gone back into why. And then by Saturday or tomorrow being Friday, late in the evening, we would get one information called the CFTC's report, which is the COT report, the CFTC's report, where they ask all the big traders, what did you do this week? What did you trade? How much of your money did you put in an economy or a particular market? And then they will declare it that this is what we did on Tuesday of this week. And you'll start to see that the sentiment of these big traders, is it now getting stronger for one economy or is it getting weaker for that economy? And that is where you learn into things like my COT report. When you look into the COT report, you then start to see, okay, the US kind of lost strength. So let's go straight directly to the US economy in this case, right? I don't want to waste your time having it load and all that stuff, but when you dive into the US economy, you'll be for now you might wonder what all of this looks like, but let me just tell you what it means. It means these are asset managers. Asset managers is the one in deep blue, and asset managers, these are people who they are what do they call them? Institutions. People tell you follow the institutions. I won't bash that yet. I won't tell you about anything that yet. Then there are leverage funds. These are people who they are certified traders, certified trading advisors, CTA. These are actually this one's called leverage sentiments, right? You see, watch when I put my mouse above it, it highlights a particular one, right? So that particular one is certified trading advisors. These are people who actually take people's money and they actually trade the markets speculatively. Asset managers are people who invest in markets. There's two different things. I'm going to explain that in some other time. And then there is retail sentiment. These are the traders that the CFTC cannot group into asset managers or leverage fund traders or non-reportables. That is, when you say non-reportables, you're talking about the central banks. So non-reportables, you cannot group them. So they just throw them retail sentiments. Now, most times these guys in the retail space, retail sentiments, they are mostly wrong. Most times. But that's not the point. The point is, if you look at the different stance of these different people, these are the main market participants. When you look at their stance, you start to know, is this asset more valuable now or is it less valuable now? Now, this is their stance over time, ever since January 2025. This is their stance. This is how their stance has changed. You can see that leverage, these asset managers, they went all the way from being very, very positive about the dollar back in January 2025 to being very negative about that same dollar in September 2025. Now they are extremely positive about the same dollar again today as of June 2026. That was just last month here. Look at the leverage fund traders, similar scenario. There are times when they feel like this asset is worth buying. There are times where they feel like this asset is worth selling. So if you look at all that scenario, it now tells you, okay, this asset I think is more valuable. For example, we got news today that said the dollar is not really worth that much as it used to be as of yesterday night, right? And then imagine this data comes out and you see this line drops even further. It tells you one simple thing. When you are trading anything against the dollar, you should rely less on the dollar than you were relying on it yesterday. That's simply what it is. So with all of this, we've understood why, we've understood who, and now we've understood when. So tomorrow we'll also be looking into, like I said, tomorrow we'll be looking into those why. What actually makes up that why? These economic indicators. This is what makes up that why. So tomorrow we'll go into that and we'll discuss all about it. So I hope you guys had a very good situation. Tomorrow, I don't have a specific time. I wish I could create a specific time for it. Yesterday, I had this video earlier. Today, this is when I had the time to make it. Tomorrow, I'll try to make it as early as possible. If you want to, if you want to catch up, you can join my Telegram, and you can also ask me questions on Telegram. I'll answer to you. I'll tell you when it's getting ready and when you can be ready for the stream. I like to do it live. I don't want to record a video and send it out. It's live because I want you to participate. I want you to ask questions from time to time. So with this, I'd like to tell you thank you for coming. See you guys tomorrow. We'll be looking at economic indicators and we will finally figure out for real, items that really make up the why. And then that why will move from there. See y'all. Peace.